What's the first thought that comes to your mind when you hear the word recession? Sell all your stock holdings and sit tight on cash, isn't it? Well, we all know that the stock market usually enters a bear phase during a recession. And to add to that, a recession has no expiry date. It can last a few months or drag on for years. But what if I tell you that it's all about perspective? That a recession could actually be good news for investors. Wondering how? Look at it like a stock market sale, where shares are available at a significant discount to their normal levels. But just like an experienced shopper, you must be able to identify a good bargain. Don't buy into anything and everything just because it's cheap. Pick a sound strategy and invest for the long term. Now the question is, how safe is it to invest in a recession-hit stock market? Well, we'll try to answer this question in this video. But first, do subscribe to Money Control's YouTube channel and don't forget to like this video. Let's first understand why stocks fall in a recession. Well, one way to explain stock price is that it is the present value of future cash flows that a company could earn. A recession would invariably indicate lackluster future sales and hence lower profits. Now, this would lower the present value of future cash flows and hence lead to a fall in share prices. But don't forget that it's a cycle. Economies recover from recessions and so do stock markets. Therefore, any fall in the stock market is also an opportunity to pick up stocks at low prices, especially for the long term. But even if you gather the courage to invest, the key questions remain: when to invest and how to invest. Can you accurately gauge the lowest price or time the market in a bear phase? Unfortunately, no. There is no formula that will predict the right time to invest. So what do? Focus on the strategy instead. That's the advice from investment professionals. Now, there are two main investment strategies that you can opt for. Instead of trying to invest in individual stocks, you can opt for mutual funds. When stock markets recover from a bear phase, the recovery is usually broad-based. By investing in mutual funds, you can reap the benefits of a broad-based recovery. The return may not be as much as that of some of the top-performing stocks. However, the risk associated with the strategy will also be lower. You can also directly invest in stock markets, but this strategy is only suitable for those investors with adequate knowledge of how the stock market works and what causes price movements. It is also suitable for investors who have the ability to absorb losses without financial distress. Such investors are also aware that certain sectors are more resilient than others in a bear market. For example, companies from sectors like consumer and healthcare are more resilient due to the nature of demand for these goods and services. Now, a knowledgeable investor would also know what to avoid. So, your cyclical sectors such as real estate, where the turnaround period is long, is something that you should avoid. Investors who conduct in-depth research would also pick companies that tend to do well even through a recession. So a recession can be an opportunity for you to participate in the stock market at bargain prices. However, the time horizon in such investments should be long-term and you must have a sound strategy that suits your investment style. For more such updates, keep watching this space and don't forget to subscribe to the Money Control channel.